Exercise 10. Colgate Company experienced the following events and transactions during July, and we're asked to prepare journal entries, including any adjusting entries as at the end of the month, to record these events using the procedure of initially crediting the unearned fees account when payment is received from a customer in advance of performing the services. July 1st, received $1,600 cash in advance of performing work for Vivian Solana. Our company's policy is to record this initially as a liability. We debit cash for $1,600 and credit the liability account unearned fees for $1,600. On July 6th, received $7,700 cash in advance of performing work for Iris Haru. Again, we record this as a liability based on our company's policy, debiting cash and crediting unearned fees. On July 12th, we complete the job for Solana, at which point this is no longer a liability. We've done the work, so we record the revenue. On July 12th, we reduce the liability, debit unearned fees for $1,600, and credit the revenue account fees earned. July 18th, received $6,900 cash in advance of performing work for Amina Jordan. We record the liability, debiting cash and crediting unearned fees. And then on the 27th, we complete the job for Haru. Since we've completed the work, we no longer have the $7,700 liability. On the 27th, we debit the liability account unearned fees for the amount recorded back on July 6th, the $7,700, and credit the revenue account fees earned. On July 31st, we note that none of the work for Jordan has been performed. The $6,900 collected from Jordan is currently in the liability account, and since our liability stays at $6,900, since we've done none of the work, we won't record an adjusting entry. We need the balance in unearned fees to stay at $6,900 until we've done some of the work. Part B asks us to prepare journal entries to record the same events, only now our company's policy is to initially credit the fees earned account when payment is received from a customer in advance of performing services. On July 1st, we received $1,600 in cash from Vivian Solana. We haven't done the work, but we're still going to record this as revenue, based on our company's policy. Debit cash, $1,600, and credit the revenue account fees earned. On July 6th, we received $7,700 cash in advance of performing work for Iris Haru. Again, even though we haven't done the work, our company's policy is to record this as revenue, debit cash, and credit fees earned. On July 12th, we complete the job for Solana. When we received the $1,600 from Solana back on July 1st, we credited the revenue account fees earned. Since we've already recorded this as revenue, and we've already done all of the work, no journal entry is required on July 12th. On July 18th, we received $6,900 in cash in advance of performing the work for Amina Jordan. Again, even though we haven't done the work, we record this as revenue, debiting cash and crediting fees earned. On the 27th, we complete the job for Haru. We already credited the revenue account on July 6th when we collected the cash. As of July 27th, we've done all the work and have already recorded this as revenue, so no additional journal entry is required. And on July 31st, it's reported that none of the work for Jordan has been performed. Well, when we received the cash from Jordan, we credited the revenue account, indicating that we'd already done the work. And it's important as of the balance sheet date, in this case July 31st, to make sure that all assets and liabilities and the resulting revenues and expenses are accurately stated. To say that we've done $6,900 worth of work would be overstating income in the month of July. We have not yet done the work, so we will need to prepare an adjusting entry. We'll debit fees earned to reduce the amount of revenue recorded by the $6,900 and credit unearned fees for $6,900. Letter C. Under each method, determine the amount of earned fees reported on the income statement for July and the amount of unearned fees reported on the balance sheet. So let's go back to the journal entries from Part A. On July 1st, we credited unearned fees for $1,600. On July 6th, we credited unearned fees for $7,700. On July 12th, we debited unearned fees and credited fees earned for $1,600. On July 18th, debited cash and credited unearned fees for $6,900. On July 27th, debited unearned fees $7,700 and credited fees earned. And on July 31st, there was no adjusting entry required. So the balance in unearned fees as of the end of July in Part A is $6,900. The balance in fees earned is $9,300. Now let's go look at Part B. On July 1st, we debited cash and credited fees earned for $1,600. On July 6th, we credited fees earned for $7,700. On July 12th, there was no journal entry required. On July 18th, we credited fees earned for $6,900. On July 27th, there was no journal entry. And on July 31st, we credited unearned fees for $6,900 and debited fees earned. The adjusted balance in unearned fees is $6,900. The adjusted balance in fees earned is $9,300. So regardless of the method chosen, initially using the balance sheet or initially using the income statement accounts, as long as you prepare the proper adjusting entry, the financial statements will work out just fine.